Thanks for the invite. Hi, everyone.
So Amelia has a very diverse background. She's been done a lot of things with 17 years of experience in the markets, worked on Wall Street, worked for several big names in the business, and has a economic training as an economic person. um, and she's got a lot of experience and also experience as a retail trader. And so she has done training for retail traders and has a monthly webinar where she teaches real retail traders and focuses on teaching them about what's going on with event risks, current events that are happening in the world, and how that can impact your trading. So we're going to dive in deep and get a lot of great insight from her today. So pay attention, and you're going to learn a lot of good stuff. So Amelia, can you get started by giving us a little bit of background, like how you got involved in the world of finance?
Sure, that's a fun question. So, I was recruited out of college. I majored in economics and political science, and I was recruited to the Federal Reserve Board. And at the time, it was the Asia financial crisis, if people remember that. And I worked in the International Finance Division at the Federal Reserve Board in Washington, D.C. So that's a little bit unusual because normally when you work at the Fed, the division that's largest is, of course, the U.S. Economic Division. But I didn't. I worked in international. And when I got there, it was really exciting. They were working on a big project that they'd been working on for many, many years. And they were like, wait till you see this. This is great. And that project was called the Euro because the Euro was introduced January 1, 1999. So I was at the Fed in the International Finance Division in 98 when they were working up to that release of the euro with the ECB, with other obviously G10 central banks preparing for the launch of the euro. And we did see a trade the first day of January 99. So it was always really exciting. And I was kind of in foreign exchange from the start. I was certainly in international and certainly in foreign exchange from the start. And then that whole period kind of like at the time and afterwards was Asia financial crisis. And so really interesting things were happening at the Fed when I was there. The Fed at one point, Bank of Japan intervened in the yen, so I got to see that from the central banking side at the Fed. So I got to see a lot of things in that period of time. And then what happened was one of the senior people at the Fed left and went to Wall Street, went to Deutsche Bank in New York City, and took a few of us with him if we wanted to go to Deutsche. And so that's what I did. I left the Fed and I went to Deutsche Bank in New York City, and I started there on Wall Street. And that was a whole ride in and of itself that launched my Wall Street career. And I basically stayed on Wall Street for about 15 years.
Wow, that is pretty good. So you worked for Deutsche Bank in New York City. Uh,
Yes.
that's and the Federal Reserve, a lot of experience, a lot of
Yeah.
insight from probably very experienced people that have, because you were a beginner and just learning out, probably had access to a
Yeah.
lot of people who really had good experience. So what were some of the key things you learned during that time?
I was lucky because, as you just mentioned, I was junior, and then I was around very senior people, not only in the government, but when they came to Wall Street, they became senior on Wall Street. So that gave me a lot of access to meetings and learning things very high level as well. And of course, then there was the burst of the NASDAQ bubble and the terrorist attack, 9/11, and 2001 and the commensurate recession. So it was really just my first years of my career were really kind of volatile with all these world events happening. And I think that the thing that I immediately learned was how several things, just personally from a work perspective, it was how competitive these environments were between the research at the Fed and how competitive the economists can be in a good way, meaning how high the bar is for their research and their papers and how they're questioned about it. And then on Wall Street, just how competitive it is to how you have to up your game and stay ahead of the pack to kind of keep your job on Wall Street when it's recession and things like that. So that would I was off and running immediately and had been used to working at what I thought in college and stuff was a high level. But it had to move to a whole other level that I entirely wasn't expecting at the start of my career. And so you do realize how competitive these jobs are to keep. The other thing I learned was just how involved and international the world is in the world of finance. So Deutsche was certainly a large global bank at the time, and the Fed just dealing in the international division, all the cooperation that you saw between the central banks during the Asia financial crisis. You realized how important saving the financial system is, how many people work to do it globally around the world when a crisis happens. And it was really eye-opening.
Now, after working in the professional side, you went then looking at a global picture, looking at what you call the macroeconomic events. Then you went and moved over to technical and trading. And tell us how that transition went. How long did it take you before you decided to make that move?
When I started at Deutsche, I was originally in the economics group, but I was always within global markets. And during Deutsche, it was 2001 also, it was a recession that followed that. And so they were laying off a lot of people at the time. And so we kind of all had multiple jobs. They just give you another job to do, which was good and bad. But it allowed me to advance very quickly at Deutsche, and they put me on the foreign exchange trading floor as a strategist. They transitioned me there. And so I then worked later at UBS in FX strategy as a North American head of FX strategy. And those roles, by the way, Deutsche and UBS at the time that I worked at them, not anymore, but at the time that I worked at them, they were 1 and 2 of the world's largest foreign exchange trading banks. So we had a ton of liquidity and a ton of FX flow that came through on a daily basis. And that also gave me access as a strategist to talking to some of the world's largest hedge funds and real money funds here in the United States, especially. So I learned a lot about how they trade. But to get back to your question, towards the latter part of my career, I really wanted to trade and do sales. I wanted to move out of strategy and have a P&L, a business that I either brought into the bank or traded myself. And so I moved into foreign exchange hedge fund sales, senior hedge fund sales, and senior institutional sales for the latter part of my career. And so to make that transition from strategist to FX salesperson, you're responsible for taking orders and running the order system and then allocating the trades, and in addition to bringing in business to the bank and keeping your clients informed. And so I had known how to do these things, but you really have to learn like the technical systems of the bank, and you have to be very fast on Bloomberg chats to trade, because everything it wasn't completely electronic yet. So at the time, so you were still trading by voice and over the phone, and you were still trading on Bloomberg chats. So you have to be very, very fast and obviously very, very accurate entering these orders and doing IMM roles and things like that. And so I worked really hard at the start to, it was a risk for me to be hired into an FX sales position, because the bank that hired me, they were putting me in a senior FX sales position, and I had never done FX sales. So I had only done strategy. So I had an advantage in the sense that I knew so much about the market, but a disadvantage in that all the technical aspects I'm referring to and the quick aspects I hadn't had down yet. So I worked with a couple other salespeople. We would do mock trades, meaning like they'd come to me on a Bloomberg chat. We wouldn't be trading, but as if we were trading, practicing the speed and the execution over and over again. And also when you're in a dealing room, the language in foreign exchange is a little bit looser than the language in trading equities. So, you have to be very careful. Like, and clients tell you their trades or place a trade with you in different language, different trading language, meaning like instead of, they may say buy, sell, or, if you quote them on a two-way price, or they may say left side or right side, or they may call you and be like, I'm on an IMM day. That's when you roll positions forward, typically to the next IMM date. Real money does that a lot. They'll just call you in and be like, I have, 500 million Aussie right hand side. And that's the trade. They're telling you to buy, to roll it forward, to buy Aussie. Right hand side means buy Aussie. So you need to know what it, you need to know all the language, because you can't obviously ask them what it means. You're a senior trader, a senior FX salesperson at a major bank. So you just have to make sure all the language is correctly. And at the start, I had pinned to my computer, taped to the bottom of my monitor, like buy, sell, left, right, uh, I give you, I take, you know what I mean? All of the different languages. Because you may even do a two-way quote. Sometimes it's easy. You'll do a two-way quote, like for euro, and they may just say the number. So say right now euro's like 116.64. So they would say price in 50 euro, for instance. So you would quote them. You don't have to say the figure, so you don't have to say 116 because they'll know what it is. So you would say, like, say 63.65, and they'll be like 65. So that means by euro. So you just have to make sure all of the language conventions are intuitive to you, so you know immediately what they mean. And so that was probably the hardest thing for me to get down. And that's why I kept the notes taped to my monitor, because sometimes you're stressed or you have multiple things going on and you might blank if they say left side and you're like, or, take, and you're like, wait a minute, what did you buy, sell? So you don't have time to figure that out when you're actually trading. So it made me faster, and it made me very technical, and we'd even practice. You can practice at home, everybody, too. Like, as I just said with the handles for euro, say, like, this is a really fun thing to do. And this is what FX traders on Wall Street do even if you're a junior trader, this is what they teach you to do. So euro, the handle right now today is 116. And say Kiwi today, the handle 65. So 65.48. So the handle 65. So you have to know for all the G10 currencies, at the start of the day, like, you should be able to name all of the handles without looking at your screen. They want you to know all of the handles for all of the currencies. You should be able to know that. So little things you can start to practice.
So I got a couple questions for you right now, because you were kind of speaking things. I had no idea what you were talking about. Okay. So you said handle. What is a handle?
It's like the big figure of the trade, right? So once again, I'm sorry if I'm using language, because foreign exchange is odd. It's an odd asset class. It's a niche asset class on Wall Street, even though it's the largest, it's like $4 trillion a day in liquidity. It's the largest turnover. But our language in foreign exchange trading is looser than in like bonds or equities. So the handle is like 116, the figure. So if euro's at 116.62, like it is right now, 116 is the handle, and the big figure would be 116. And if it moves, if we say euro rises a big figure, that means it went to 117. So same thing with like Kiwi's at 65.48 right now. So the handle's 65. So if you were on a Wall Street trading floor right now and someone's trading a currency, if they asked you to quote the currency for them, for like euro, you wouldn't say 116.62.65 if you're giving them a price. No, because they know it's at 116. Everybody knows it's at 116. So and that wastes time speaking. So you would just say 62.65, and the client has to know it's 116, and you have to know it's 116. So that's why you always need to know those handles, because if you're on a trading floor, no one will say for New Zealand dollar right now, 65.45. They'll just say 45.47. And you have to know it's 0.65. So that's what I'm talking about.
Well, that clears it up for me, so thank you. Now, when you said you moved into FX sales, does that mean that you were filling orders for clients, or were you actually trading?
So it depends on the bank. So FX sales just fills orders for clients. So remember, by the time I came to the banks I was always on the trading floor as a strategy, but by the strategist. But by the time I came to the banks in FX sales, the Dodd-Frank bill had come in. So that took away all of the leverage, or a lot of leverage, I should say, for banks. And there used to be, but prior to Dodd-Frank, especially way back at the start of my career in Deutsche Bank, we used to have FX prop traders who would be on the desk. So we had both execution traders and then proprietary traders who had a sum of money for the bank that would trade. And that was pretty usual at the start of my career. But towards the latter part of my career, when I was more senior, because of the Dodd-Frank bill, those prop traders went away at all the banks because the leverage was reduced. And so you just had execution traders who would execute orders, and maybe you can take a little bit of positions like on your own. And in terms of salespeople, we take all the orders from the clients, and then and we enter all the orders in the order system, and then we split all the orders all the different ways, and we watch all the orders, so we have to tell the traders this order's closed, that order is closed. And when they come in to deal, I give them the price. So I would get a price from the trader, but I'm the one who gives the price to the client, not the trader. And so I can change the price a little. I can't change the price so much, but I can change the price in terms of trying to add a pip or something like that to make money on the trade myself. So for the bank, on behalf of the bank. So that's how that works. And some traders, like we would execute orders like if it was $50 million and under, then we can trade it ourselves. But 50 million and over has to go to the actual trader at the desk. So we work very closely with the actual traders. So
I interview quite a few currency traders on this show, and they've all been from the retail side for the most part. And a couple of them have said to me, oh, well, you got to try to follow the banks. The banks are the ones that move the markets. All we're doing is just riding their coattails because they're the ones that are moving. So you're coming from the other side of that. So I'm just curious what your take is on that, and as far as banks moving the markets and taking big trades that will actually move and change the handle of the current day.
Yeah, for sure. So as I said, when I was in the markets, especially Deutsche and UBS, we were the world's largest foreign exchange traders at the time. So for me, and my challenge in going to retail later was the sizing of the trades are so different. I mean, even as a salesperson later in my career at smaller banks like Westpac or smaller FX banks, not smaller banks in general, but the hedge fund clients will come in and hit you in clips of 50 million, 100 million that you're trading at once. And very quickly. So the volume is definitely there. And as a retail trader, they're right. Who you spoke with, I would never attempt to stand in the way of a central bank flow. At one point at UBS, we were the world's, at that time, the trading floor was the big trading floor in Stamford, Connecticut, which is no longer there. They're back in New York. But that was like the football field size trading floor we had. And we were the world's largest trader of South African rand, and it was traded mostly at the time via algorithm. And so it was electronically traded. So, I know from those rand trades, like never stand in front of a rand trade. You'll just get run over. So it's true. The retail size is so much smaller. It's not like equities. You kind of hear now about Robinhood, how, they're driving all this money into these individual equities like Tesla or, Peloton or something exciting. But that's not how it happens in foreign exchange, because the volumes the liquidity on a daily basis is too large, and it's central banks participating, investment banks participating, hedge funds with a lot of leverage participating, real money, and retirement funds participating. So yeah, you kind of have to not fight the market.
Yeah, and about the equities, I hear that same thing about Robinhood, but I'm not sure that I actually believe it. I think it's kind of just a media story. I know there's a lot of new traders. I know there's a lot more people trading now, but I don't think that those Robinhood traders are the ones that are actually moving the markets and the reason why the markets are doing what they're doing. I think that's just people talking.
Hype, yeah.
Yeah. I mean, that's my opinion. I have no way to prove it, but
you're right.
Yeah.
But it's interesting. I feel like retail trade, and speaking and meeting with a lot of retail traders, which I did over the past year at the money shows and Traders Expo. This was pre-pandemic. It stopped during the pandemic. It went virtual, but we used to meet in person. And speaking to them, I feel like retail traders felt they had a little more control over a single stock equity or something, and less control over foreign exchange. So that from their perspective.
Well, hopefully you pointed out that that's an illusion, because no one controls the markets. Well, maybe
true.
the banks, but once you're a retail trader does not control the markets.
No,
they
retail trader
just
doesn't.
trade, and
Yeah.
whatever the market wants to do, the market's going to do.
Yeah.
And
that comes into play too with I would get asked all the time when I spoke at retail trading events, like picking a top or a bottom for foreign exchange, for like a currency I'm talking about. And like, you never pick a top or a bottom. I don't know why you would try to do that. Like, wait till it turns either up or down, and then you can join the momentum. But I was like, we call that, I'm sure you have it in equities too. I don't know. On Wall Street, we say, like, for instance, if you don't want to catch a falling knife, right? So that's kind of like the trade,
right.
You think you're going to something like, say, pound or euro, or, you have a currency that's in decline, say the sterling is in decline, and you think the bottom. You have all these reasons why this is the bottom. So you're going to go long sterling now that it's weak. You want to go buy it and go long, get in like inexpensively, quote unquote. And you'll just catch a falling knife. That's a saying, at least in foreign exchange. You're going to catch
I've
a falling
heard that
knife.
a lot. Never try. That's one of the trainings that I've learned over the years and that people have taught me. Never try to catch a falling knife because you'll get hurt.
Yeah, and I've seen big hedge funds do it too in my career. It's not just only for retail, it's for big hedge funds too. Just don't do that.
Right, and I've heard news reports about banks getting themselves into trouble with not following their own rules. Big firms taking billion-dollar losses because they went a little rogue.
It's always best, and I've seen it both on the execution desk at a sell-side firm, meaning we are taking the orders for a client. And when you're taking the orders and trading, executing them for your hedge fund client, or you want the client to do well, right? Obviously, you want them to remain a client, and you don't want them to be losing tens of millions of dollars on these trades you're placing for them on behalf of them. And it's always, anyone who's worked on a sell-side execution desk, especially in foreign exchange on Wall Street, they know you'll have this client who's probably a really, a super smart client, a hedge fund, and they're coming in and they're placing a trade and they believe that they're right, and they believe that they're right, and they're moving their stop, and you're just sitting there like watching them hemorrhage money, and you're like, don't move you can't do anything.
Are you allowed to tell them like, hey, I'm not sure this is a good idea?
You can't say that to them as a trader, but as an FX salesperson, you can say that.
Yeah.
If they call you, sometimes they'll call you.
Like, what's your risk parameter on this trade?
Yeah, and sometimes as a FX trader, if you know the client well and you've had them as a client for a while and you've seen them in person and talked to them, you know what I mean? Sometimes if they place a voice trade with you, moving the stop again, the first thing you do in that situation is you absolutely move the stop. So you have to do what they tell you. So you absolutely immediately move the stop. And then if they remain on the line, you can say what you're seeing in the market, like, ooh, this feels like it's going to go through that level though, or that's what we're seeing, So you can
might as well get out now. Get out now, cut your losses, and by moving the stop, you're just increasing your losses.
Yes, but the biggest losses on Wall Street that I saw among clients and myself, because I did work at a couple hedge funds as well, were when we didn't obey our own stops, when we continued to think we were right and we'll just move them a little, and we continue to have losses.
Yeah, and that's very tempting. No matter where you're at when you're trading, you don't like taking a loss, and that's something that I've had to experience. Even today, I had my stop loss on, and what I did was the platform that I use, if you drag your stop loss, it won't actually move it down until you let go, until you release the click. So I had dragged it down, and I didn't release. I was just holding it, and then I was like, I'm not going to do it. But then the market hit my stop before I released the button, so it took me out before I had a chance to break my own rules. And it didn't feel great, but now that I'm in hindsight, I'm like, okay, that's all right. In the past, I might have moved my stop and I would have taken a much bigger loss, and so I'm okay now.
When they talk about this, you hear it in the markets, you have to have discipline as a trader. That's one of the most important things to have, is discipline. But what do they mean by that? And this is an example of what they mean by that. Obeying your stops that you put in, pre the trade when you entered it, and not, you have to have emotional discipline as a trader. not to sit there and take the losses if you have to, or,
Right. So
not make them worse. Let's put it that way. Not make them worse.
So as coming from the banking world over to retail and talking with retail traders at the Money Show, and now you do webinars, what are some of the things that you think that perhaps you learned from the banks that retail traders might not pay a lot of attention to, or maybe don't even talk about at all, that you could kind of open up their eyes to?
Definitely the event risk calendar. So at UBS, when I was there as the head strategist in the Americas, we had both a Monday meeting for all cross assets for everyone on the trading floor that, even London would call into, and then a daily meeting on the trading floor, which I would run, about the event risk coming up for the day. And, is there a central banker speaking? Is it an ECB or a Fed meeting today? What time is the press conference? What are the major data releases today? And so there's so much going on in a day normally, especially in macro. You have to pick the events that you think will move the markets the most. So you can't tell everybody everything that's happening today, because that almost becomes pointless. But you do have to pinpoint the things you think will move the market today or over the next week or over the next month. And it's very important to do that. And so when I would speak or go to these conferences with retail traders, a lot of them are Elliott Wave traders, or a lot of them, at least in foreign exchange, are Elliott Wave traders, and a lot of them are technical traders. And so they wouldn't pay attention to the economic calendar. And that, is I don't understand how you cannot pay attention to the event risk or economic calendar. And so that's why I started my webinar that goes over global macro event risk and pinpoint specific themes and dates that you can follow, when the market is more likely to move. Because if you're a technical trader, you're looking for a range break, or you're looking for a level break, right? And you need to know, it would be helpful, let's put it this way, to know if a certain currency was more likely to break a range or break a level on a certain day because of an event pertaining to that currency that's happening on a certain date.
Now, I am a currency trader, and what I do is every day before I start trading is I go to the calendar, the economic calendar, and I see what events are happening and what time. However, I don't try to interpret those events because it's just too complicated for me. For example, very simple ones like jobs data, right? That one has a tremendous impact on the market. And sometimes my prediction would be, well, if the number's good, then the market's going to go up, or the dollar's going to go up, but then the reverse actually happens. The number was good, but the dollar's going down. I didn't think it worked that way. What's going on? So the interpretation of the data, since I could never figure it out, I just followed what the price was doing. If there was a big deviation and the price went up, well, then I would try to take a trade based off of that rather than trying to interpret it. When you're trading, are you analyzing the macro data and then trying to use that data to determine the direction that the trade is going more likely to move?
I think to answer your question, the answer to that short is yes. But I do a lot of work into it. So the Global Macro Risk Event webinar, it watches event risk, but it also watches what we call macro themes that are driving the market. And a lot of the macro themes that are driving the market is a little bit what you're talking about here. It's correlation. So correlation between the dollar and S&P 500. So sometimes when it's risk off and equities fall, the dollar gets strong because it's a safe haven currency. But sometimes that correlation is usually generally intact, but it changes a little bit. It gets less correlated, or maybe the dollar, because something bad is happening here in the United States, it's on its back foot, and the yen becomes the preferred safe haven. So the yen strengthens instead of the dollar. So we watch kind of changing correlations like that, big ones like S&P 500 US dollar, S&P 500 dollar yen, because you really want to have a handle. S&P 500 10-year bond yields, and there being the correlation there right now is changing. But to answer your question, when you have a hard time maybe when there's a strong data point for something very important like U.S. payrolls, employment, and the dollar doesn't behave how you would think it would on the day or at the time when the number's released, a lot of that usually has to do with understanding the correlations going into the number. And so I do watch that very closely. Correlation.
Okay. That's actually that makes a lot of sense, and that helps me out. It seems like in the last 2 weeks, especially, and it may be going longer, but I've just been kind of paying attention for the last 2 weeks. But the dollar's really connected to the S&P. Like with the S&P moving down, the dollar's been getting stronger. But before that, when the S&P was moving up, the dollar was getting weak. So it seems like right now it's really strongly correlated.
It is, yeah, and you do have, because that correlation does change, so you do have to watch it. In 2019, I did really well retail-wise trading dollar yen with the S&P 500 or with like Apple. Just on certain days, Apple would be down heavy and yen would be strong. I mean, just on an intraday trade, a short trade. And that worked really well kind of throughout 2019, and it doesn't work at all in 2020. It just doesn't work because that correlation between dollar, yen, and U.S. equities, is less now. So that trade just doesn't work in 2020.
That's interesting. How do you discover these correlations?
I chart them. So, just on my systems, if you have Bloomberg or I have TD Ameritrade up as well, Thinkorswim, I just correlate. You can use your chart monitor and I chart them 2 line S&P 500, US dollar. It'll even give you, the R squared and things like that. So you can watch it very closely, and you can just look at it on an intraday basis also, and look at it on a weekly basis. And if you look at it kind of week to week or even month to month, if it changes, you'll definitely see it in the chart. So it's something to note for sure.
Okay, cool. Well, that's about it for today. So I want to just give you a little bit of, give the listeners an opportunity to get access to some of your webinars or anything else that you're offering right now. If they're looking to find out information from your training, how would they get in contact with you?
You can go to my website, www.marketcompassllc.com, and I have a product tab, and under that's the webinar. And there's a video, like a 3-minute video that tells you more about the webinar and some text that tells you more about what you get in the webinar. And then it's a monthly subscription. You can just subscribe month to month right at the bottom. And there's so much changing between the election and Brexit and the start of the new year in January, and the new money that comes into the market every January on the sell side and with hedge funds. So a lot of macro things going on that are driving markets. So I would think it would be helpful for you. You can follow me on Twitter at Amelia Bourdeau for kind of intraday comments, and on Instagram, I do Instagram stories for news updates at Market Compass. The other thing I do is I do consult for institutional clients. And if you want some institutional charts, a little bit what we talked about today on correlations breaking, at Ex Ante Data. They're a company that uses alternative data to look at the markets. So it's very interesting. They put daily chart updates for free on Twitter. They also follow coronavirus, which has been so important. They're one of the leaders when they started following coronavirus and charting it every day and putting it out there on Twitter. And they're also follow foreign exchange markets. So at Ex Ante Data for
Can you tell me the name? Can you tell me the name of it again? Because I want to check it out.
Sure, Ex Ante Data. So that's EXANTE.
EX.
Yep, ANTE DATA.
Oh, okay. I see. I'm glad I asked. Ex Ante Data. Okay, got it. I got it. All right, cool. Thank you.
So check it out, because we have a lot of cool charts on there for free on Twitter, and we update them every day. So, and then check out my webinar too on Market Compass LLC.
Yeah, and so you talk some about correlations and the market risks at your webinar as well. So it would be for basically any type of traders. It wouldn't just be currency. If you were in equities, you're going to be covering some of those events as well.
Yes, that's true. So the trade recommendations given in the webinar are currency only, but all of the macro themes that we talk about are cross assets. So we're going to look at equity markets, maybe even single name equities, sectors, and bond yields and currencies in the U.S. So it's cross.
Now, when you're talking about you'll be giving some trade ideas and things like that in the webinar for currency, what type of time horizon do you usually you do your trades based off of?
I will look ahead because it's an event risk seminar. So I'll usually identify an event, and then I'll tell you to trade, kind of like around that event and something to look for. But those trades will be short term. So they're not immediate, as in you can place the trade right after the webinar. They're usually like looking, okay, in about a week's time, we're going to do this. We're going to try this trade. And then it'll be a short term trade. So it's usually just an intraday trade or like a 1 day trade. So I know retail traders are in and out of the market much quicker than a hedge fund, which would leave it on for 3 weeks to 3 months. So
Right.
I don't expect a retail trader to do that. That's not possible. Well, I don't want to say it's not possible. It's just very difficult.
You got to have a lot of money
to
make those big trades.
And you have to have a lot of time, too, to manage it.
Right. Yeah. Right. Well, that was a great show. So everybody that was listening, go ahead and check out marketcompassllc.com. Get signed up for the webinar. All of the resources that Amelia mentioned will be in the description, in the links below when this is released. So thank you so much, Amelia. Really appreciated having you today.
Thanks for your time. Thank you, everybody, for watching. I appreciate it.
All right, guys. Until the next episode, thanks for listening.